Today we're going to dive into one of the most important factors that influence your retirement. That is your asset allocation and your asset location. Your asset allocation and your asset location are the vehicle that drive your portfolio, your returns, and ultimately your goals in retirement. When you think about asset allocation and asset location, there are some key factors that you need to consider. And that is, number one, your investment goals. Number two, your investment time horizon. Number three, your risk tolerance. And finally, your tax situation. So when you think about your investment goals might be short term or they might be longer term. Think retirement. When you think about your investment time horizon and your investment risk tolerance, you need to think about when do you need these funds and what is the risk that I'm willing to take on relative to how I am invested. When you think about your risk tolerance, this is simply the emotional and financial ability to take on what we call market volatility. And when you think about your time horizon, it's important to align when do you need these funds with what is the risk that I am willing to take on. And finally, the reason we bring up the tax plan is making sure that you create a tax efficient strategy now and in retirement. So with all of that said, let's dive into a quick example case study here. Here we have James and Lindy. The reason I want to dive into this is my hope is this aligns all of the questions you have with a real life case study. So here we have James and Lindy. Across all of their accounts today, they have a 70-30 portfolio, effectively. 72% equities and 28% fixed income, with a hypothetical annual rate of return of 9%. Now, they have a variety of different accounts here, and each account has a different goal. James and Lindy today are a couple years out from retirement. That said, they're planning today. They're trying to be proactive in their planning to make sure that they have a clearly identified strategy for where they're pulling funds from and how they're allocated going into retirement. So let's look across all of their different accounts. We can see here that they have a joint investment account. This is a taxable brokerage account. They have a 50-50 allocation in this account with a hypothetical annual rate of return of 7.4%. Now, why do they have a 50-50 allocation in this account if they're several years out from retirement? Well, James and Lindy in retirement are going to have what we call an income gap. That is, the only income they have in retirement is their Social Security benefit. And they have expenses that exceed that benefit. And so as a result, they're going to be relying on their portfolio to fill that income gap each and every year throughout retirement. And therefore, when we look at their different accounts, we use what's called the traditional withdrawal order. First, they're going to pull money out of their taxable account. That is this joint investment account here. Then from their tax deferred accounts, that is their IRAs. And then finally, that tax-free account, that is the Roth IRA. So relative to their joint investment account, they're being a little bit more proactive here and going with a 50-50 allocation and then maybe getting even a little bit more conservative as they approach retirement. We can look here at our target allocations and we could say, okay, what if James and Lindy, a year or two out from retirement, go with a preservation asset allocation? We can see here that instead of that 50-50 portfolio, their taxable brokerage account would be allocated more so on a 20-80 allocation. That is 20% equity, 80% fixed income, with a hypothetical annual rate of return of 4.9%. Now, does this make sense for them? Maybe not today, but maybe as they get closer to retirement. If they're going to be relying on this joint brokerage account to fund that income gap, we know that they're going to have liquid needs. Plus, they are not going to want principal fluctuation. Rather, they want more stability. And therefore, our goal becomes preservation of capital with some income. So this is a really cool feature because we can see here, hey, if James and Lindy want to go to what we call that preservation allocation, what do they need to do to their portfolio today? And as we can see here, we need to reduce equity exposure across the board. We need to reduce our real estate exposure, and we need to increase our bond exposure as well as our cash position. So scrolling up here, let's look at their IRAs. Well, James today has an IRA and Lindy has an IRA. And across their IRAs, they have an equal allocation of a 70-30 portfolio with a hypothetical annual rate of return of 8.9%. Now, they don't foresee themselves needing this account for an extended period of time, 10 plus years. And so therefore, they are okay having a more growth-focused allocation since they have that joint investment account to fill that income gap early on in retirement. But similar to what we did with the target allocation for our taxable account, we could run through what that would look like for this account. Maybe today they have this 70-30 portfolio, which is what we call the growth allocation here. But maybe as they approach the period in time in which they need this account, they start to decrease the amount of risk or the amount of volatility that they're willing to take on in this portfolio. And as a result, they get more conservative with their total allocation. So we could see here, what would it look like if they went from what we call that growth allocation to a balanced allocation? We would go from that 70-30 portfolio to that 50-50 portfolio. So what we can see here is with each account structure, we need to align that with the goals. And within that account structure, we want to make sure that we have an allocation that is also aligned in such a way that it helps us achieve whatever that goal may be. If that goal is income, excellent. How are we allocated in such a way to support that goal? If that goal is long-term growth and accumulation and appreciation, how are we invested in such a way that that helps us achieve that goal? So let's look at our Roth IRA. This is our tax-free account. How are we invested in this account? Well, we can see here that we have a 90-10 portfolio. That is an aggressive growth allocation with a hypothetical annual rate of return of 10.1%. Now, why do we have an aggressive growth allocation in our Roth IRA? Well, our Roth IRA, our tax-free account, is going to be the last account that we rely on in retirement. And therefore, we're willing to take on the most amount of risk in our Roth IRA because we theoretically aren't going to touch this account for a very long time. We're going to be relying on that taxable account and those tax-deferred accounts before we pull from this Roth account. So having an allocation that is more growth focused is the goal of this account for James and Lindy. So now that we've addressed the asset allocation and we've aligned the allocation with the goals, the timeline, the risk tolerance, and the location of this account, let's dive into what this asset location breakdown looks like for both James and Lindy. We're going to the tax allocation portion of this planning tool. And as we can see here, today they have $100,000 in their taxable account. They have $375,000 in their tax deferred account. And then they have $75,000 in their tax free account. So again, we're going to pull from this taxable account first. We're then going to pull from the tax deferred account. And then finally, the tax free account. So guys, the point of this video is when you think about your investment strategy, you need to be very mindful of what are your investment goals, what is your time horizon, what is your risk tolerance, and then ultimately, how are you allocated and where are those assets located in such a way where it is helping you achieve whatever those long-term goals may be. Thank you so much, and until next time, have a good one.